Hi, I often get asked by people, hey Tom, which asset classes should I trade? And so, in order to answer this for quite a lot of you, I just made this little presentation and I just list the pros and cons of the asset classes that are accessible to most beginners, I should say, because if you have been in this game for a while, you probably don't need this presentation. But if you're new to this, I think it would be worthwhile watching it, and then you get a good overview of the asset classes that you might be able to trade. So just to start with, I want to talk a little bit about the scope of this video. So in here we only talk about exchange trade asset classes. There are of course other asset classes such as physical gold, for example, or property, but we don't really want to talk about them here. Also, I want to talk about asset classes that are relatively liquid. Of course, within the asset classes, there are different types of liquidity, and sometimes some of the assets can be more liquid than others, but we'll talk about the relative values here. And they should also be accessible to retail traders. So I personally often recommend IB Interactive Brokers to get started. I'm not affiliated with them, by the way, but they have relatively low fees, good API, and a few other things. So usually I talk about the asset classes that are available through Interactive Brokers because this is where a lot of traders start. And finally, we would like asset classes where we have market data available, because if you are somehow into quantitative trading, then you would really like to have some market data. And Yahoo Finance here is often a great source. So they have not really got any APIs anymore for downloading market data, but there's a few workarounds in Python that you can use, and some of that is actually documented in some of our other videos. So if you want to start trading and testing your strategies, you should really have asset classes where you have market data available. All right, let's start with stocks. And this also includes ETFs, exchange traded funds, such as SPY, the S&P 500 index fund, or maybe QQQ, the Nasdaq index fund. And well, stocks are fairly easy to understand. There isn't really much not to understand. The prices go up and down, and effectively what you see is what you get, more or less. But I talk about this a little bit later. They are accessible through many brokers. So if you have any broker, quite often you can access stocks through them. And there's a lot of market data available. Specifically, if you look at Yahoo Finance or also Google Finance, you can download the market data and use them for your quantitative trading. The good thing with stocks is that unlike other asset classes such as futures and options, they don't have a term structure. So they just perpetual, nothing ever changes with them. Now, one thing that you need to be careful of with stocks, and often traders overlook that, is the fact that they are subject to splits and dividends. So when you have a dividend, you effectively get paid some money for holding that stock, and that adds to the money you can make from this stock. So oftentimes when you have market data, you have to make sure that before you do any quantitative analysis, adjust them for those dividends. And splits is the same thing. Splits are corporate actions where the stock price gets split in half, maybe, or in a quarter, and then the price suddenly changes by a huge amount. And that can, of course, have a large impact on your quantitative trading strategies, and you want to make sure that you don't take this into account before you run your algorithms over the data there. Now, one of the cons with stocks is that for most retail traders, there is little or no leverage. So, the price you pay is the price you pay. They are so-called cash instruments. And that's what you get. So if you make a 30% profit on the stock, that's what you actually end up making. And the other problem is, especially if you live in time zones like mine in Sydney, if you want to trade on the US market, you have very short opening times for the exchanges. It means, for example, here in Australia, we have to run very serious night shifts to trade equities or stocks on the US market, and that can sometimes be a bit difficult, and they can sometimes also take a little bit of a toll on your health if you are not used to night shift work. Okay, the next asset class that we talk about is Forex. Forex, again, is a fairly easy asset class to understand. What's really good about Forex is that it trades around the clock, so you can access it 24 hours a day. Many brokers trade Forex or offer Forex for you to trade, which is great, even more perhaps than stocks. The fees are fairly small, although you got to be really careful with this. It looks often that it's really small, but there are other hidden costs that could come in. And again, Forex does not have a term structure, so what you see is what you get. It never really changes. So the problems with Forex is that, and that's why I actually don't like trading it that much. The market is highly efficient. Forex is a huge asset class, and it's traded around the world. And so the markets are very efficient, and it's actually really difficult to find good trading edges with Forex. I mean, they still exist, but it's just not easy to extract them. And the other problem with Forex is that it's a lot less regulated than stocks. So stocks are heavily regulated, whereas foreign exchange is not as regulated, and that can sometimes lead to problems. And these problems are often very hidden from the trader. You can't even see them, and unless you really go through your trades with a fine-tooth comb, it's often very difficult to spot that there could be any issues here. And the other problem is that foreign exchange actually has a high cost of carry. So the overnight carry rate is generally fairly substantial, and a lot of Forex traders don't necessarily take this into account, and when they hold their currencies, they wonder why they should theoretically make money, but they're actually losing. And this is often because they miss out on this cost of carry rate. It's also called the Tom next rate, or the tomorrow next rate. And that can be pretty significant. And so there's a few hidden things in Forex that need to be taken into account when you start trading them. And just be aware of it, and it makes your life a lot easier. All right, well, a lot of people these days love crypto, and I like crypto too. I was quite an early adopter of crypto, although I'm not trading it as much today. Now, crypto is a very inefficient market, so there's quite a few trading edges to be found still, because it's run and driven by a lot of retail traders. It's generally very easily accessible, so there's many exchanges around the world, and it's usually easy to plug into one of them and trade cryptos in there. Cryptos are very much similar to Forex, so they're fairly easy to understand, and they're even open longer than Forex, so they're 24/7. They never stop. It's always, the exchanges are always open, so you can trade them whenever you want, and that's a really big advantage. And the other thing is, there's actually quite a wide choice with crypto. Obviously, a lot of the coins I would not necessarily recommend. There's definitely a lot of coins that are, well, quite not ideal for trading, and probably quite a few of them are scams. So you got to be really careful which coins you actually pick. Now, one of the big cons in the crypto market is that it's completely unregulated. So far there's not been any regulation in that market. So if exchanges decide to do dodgy things, they can easily do that, and you don't really have any recourse on that. And at the same time, you also have an extremely high counterparty risk, and as you probably know, quite a few of those exchanges have failed, and investors have lost millions or even billions of dollars in those failed exchanges. Then the other thing that plagues a lot of cryptos is that there's actually quite a high fee structure. So you pay a lot of commissions. So if you like trading a lot, then the commissions will really very much eat into your trades quickly. So you got to be really careful what exchanges you are trading, and make sure that you trade on an exchange where the commissions are comparatively low, specifically if you trade a lot. Now, the other thing that's also important is that the spreads in some of the cryptos are fairly large. So if you trade at the market, you buy at the ask and sell at the bid, then spreads can really be substantial, and you can lose a lot of money on spreads if you're not careful. And finally, of course, cryptos are extremely volatile, and so you have to be very, very careful, and you can't be complacent when you trade crypto. You have to always keep an eye on it and make sure at least the money you put in there is reasonably protected from really, really large losses. At least that's, if you have a substantial amount of money tied up in those cryptos. All right, then next we move on to futures. Futures are an asset class that I like, but they are already a step up from the previous asset classes that we have talked about. So futures are already a little bit more reserved for the professional traders, although some retail traders are running them as well. One of the good things with futures is they're trading around the clock, although they have some breaks during the trading session. They're only short though, about an hour. Futures provide you with quite high leverage, so the leverage could be between 10 and 100, and so that means a small amount of money that you put in can actually control quite a significant amount of money. So it's very good in terms of that. The futures trading infrastructure is excellent, so there's a lot of interesting platforms, most of them very professional. So if you want to use this infrastructure, usually it is, whilst really good, also quite costly. Now, one of the really good things with futures is that they're heavily regulated, and you basically, what you see is what you get, so you don't have to be worried that your counterparty defaults and you lose all your money. That's very difficult to happen. Some of the cons here: so futures are a bit less easy to have access to market data, so it's not that straightforward to get market data for futures, although if you dig around a little bit you can also find them sometimes for free on the web. Now, one of the things for beginning traders that is difficult to grasp is the term structure. So futures have an expiry date, and when futures expire, a few things can happen. One is that they settle in cash, so it means that whatever the difference was between when you bought the future and the price at settlement is provided you in cash. But the other thing is that if they are settled in a physical commodity or something, then you might end up getting delivered barrels of oil or gold bullion or something like this. And so you have to be really careful. If you actually trade futures and you really don't want physical delivery, you have to make sure you exit the contract before it expires. Otherwise, you could end up being in really deep trouble. So futures are also a little bit more difficult to access. Not that many brokers offer them, specifically the ones that are geared towards retail. And you have to pick the brokers that you want that can actually access futures. Now, the market of futures is generally highly efficient, although there is big differences. Some of the commodities are traded a lot less than others, and so the less traded ones are probably a bit less efficient as well. So it depends. The complexity level of futures is medium, so it's not as simple as the other products that we've talked about so far, mainly because of the term structure. And you might have heard of expressions like backwardation and contango. So before you start trading futures, you should really familiarize yourself with that. You should familiarize yourself with expiries and terms and what that actually means. Also ideas such as cost of carry and so on. So you actually know what you're up against, because otherwise it's very, very easy to lose money in futures trading without actually really understanding why. Okay, let's move on. Next we have options. Options are an asset class I also really like. Options are very mathematical, so a lot of the pricing in options has very mathematical precision to it. But that's not all. There's actually a lot of really complex and interesting aspects in options. What's interesting about them is they provide very high leverage. They have properties that are very much like an insurance. In some ways, they are an insurance. And there's free market data available for at least stock options on Yahoo Finance and also on Google Finance, so you can always look up the options prices. And the good thing with options is that they're also well regulated, at least your standard vanilla stock options. So you won't be in for any nasty surprises in terms of regulatory issues. Now, a few things that new traders might not like so much is that they are mathematically quite complex. So if you trade options and you want to do it quantitatively, then you have to deal with a lot of complex maths. Some of the options contracts, specifically the ones that are far in the money or far out of the money, they can be quite illiquid. So it might look like, oh, they have really attractive prices, but those options actually don't really trade. And so the illiquidity might mean that your quantitative models may not work as well as they look on paper. And because they're illiquid, they can obviously have wide spreads, which is also another issue. Specifically if you build quantitative models, those wide spreads might really skew the results of your trading models. And there's a bunch of, I would call it hidden pitfalls with options that you got to be aware of. And one that is really one that I've seen that people really struggle with is the what we call the time value of money. So options have a time decay. So if you hold an options, and all things being equal, the options price will decay over time. This is also expressed in the so-called Greek theta. It's basically the price decay over time. So the more an option moves towards its expiration date, the more it loses on value, and the closer it gets, the faster that value decay is. Obviously, options prices are also not just dependent on the time to expiration, but also on the volatility of the underlying, the implied volatility, which is really the perceived volatility by the traders, and obviously the actual price of the underlying. For example, if there's an underlying stock that the option is written about, then that underlying price has a huge impact on the options price too. Okay, so finally we have bonds, and I have to say I'm not very much an expert in bonds. Bonds are very specific to trade. They are heavily regulated, and one of the good things with bonds is they pay you interest, although these days bonds pay a lot less interest than they used to. Also, for your information, the bond price is generally inversely correlated to the interest. So as the bond price goes up, interest on bonds is going down. So that's something really important to remember. One of the hard things with bonds is they are much more difficult to access for retail traders. You need quite high cash requirements to acquire them. The market data are not as easily available, and they have also quite a complex term structure. There's quite a lot of maths involved as well if you want to dive deeper into this. And bonds are really mainly reserved for professionals, although some retail traders trade them as well. But I would say that the vast majority of retail traders do not actually touch bonds in general. However, you can actually access bond trading through some of the ETFs, such as TLT, which trades US government bonds, and that is probably the best way for retail traders to access bond trading through some of the available ETFs. So just to recap what we talked about, here is the little graphic on which asset classes are suitable. And so you can see at the beginning we have Forex and crypto, probably the easiest asset classes to trade. And then We have stocks, or here I finally call them stonks, as some people did on the web recently. And then probably the next one up is options. Options are still heavily traded by some retail traders, although most of them don't actually really know exactly how they work. Then the next one perhaps is futures. I mean, this list obviously, or the level of difficulty, is debatable, and some people might argue that futures and options should be the other way around or something. But there's no doubt in my mind that bonds are definitely reserved for the more professional traders out there and shouldn't be really used by retail traders in most cases. So before you go, please don't forget to subscribe and smash the like button so we can get a bit more traction on YouTube. And also don't forget to check out our other YouTube videos, some of which are really quite interesting. We also have 2 courses in Udemy. One is a basic Python for traders and investors course, where you learn a lot of quantitative techniques combined with learning the right programming skills in Python that help you to get quantitative trading right. And the second course is on futures trading, and it's a very deep dive into the ins and outs of futures trading, including quantitative trading and some interesting strategies that you can use in the markets. I hope you enjoyed this video, and we will see you in the next video next time. Bye bye.